Bad and mad. It's been a day of high drama on world stock markets. Wall Street reopened for the first time since the US credit downgrade, with the Dow Jones plunging a staggering 5%. A whopping $1 trillion was wiped off the value of shares. Here, the market followed Wall Street down, only to stage a remarkable recovery and finish slightly up at the end of trading. But there were casualties. The Australian dollar took a pounding, slipping below parity with the US dollar at one stage. And two of Australia's biggest banks took the knife to fixed-term interest rates. Here's finance correspondent Philip Lasker.
Welcome to the horror show, which today received mixed reviews from the audience.
I can't see it getting better too quickly, to be honest.
People want to sell. As a matter of fact, I hope my super fund's out buying.
They weren't buying in the morning.
Definitely panic selling. We've seen margin selling about 11 o'clock each day.
The volatility was remarkable. After plunging more than 220 points in the first hour, the market staged a breathtaking 270-point turnaround to finish 48 points up, over the 4,000 mark. Analysts put the rally down to speculation the US Federal Reserve will announce another round of money printing overnight.
The importance of the Fed meeting tonight, I think, is very, very significant.
But Australia was the standout. There was no such recovery on most markets in other parts of Asia.
The market at the moment is just totally gripped by fear.
Fears of a global recession and tumbling commodity prices saw the Australian dollar dive 3.5 US cents at one stage, taking it below parity for the first time in 5 months. The wild markets had superannuation experts advising investors to sit on their hands.
Making decisions in a period of extreme turbulence like this is generally a bad thing. So unfortunately, they're just going to have to batten down the hatches and wait for the dust to settle.
If the dust doesn't settle, some say the Reserve Bank might have to act. We'll know when this crisis enters a more dangerous phase for the Australian economy, because the Reserve Bank, which has been signalling interest rates are more likely to rise, will have to cut them instead.
I think it's much more likely that the Reserve is going to sit on its hands for quite a while.
Amid the turmoil, some funding has become cheaper, so the Commonwealth, Westpac and St George banks cut their fixed-rate home mortgage products. Now it's back to the routine of waiting to see what the Northern Hemisphere throws up. Philip Lasker, ABC News.